Are you tired of paying too much on your taxes? Look no further. In this video, we'll cover 4 essential tax tips that can help you minimize your tax liability and save money. From maximizing your retirement contributions to taking advantage of tax credits, we've got you covered. So sit back, relax, and let's dive into the world of tax planning. Tip 1. Maximize your retirement contributions. One of the most effective ways to reduce your taxable income is to contribute to a retirement account, such as a traditional IRA or a 401k. These accounts not only help you save for your future but also reduce your current tax bill. Traditional IRA. A traditional IRA is a tax-advantaged retirement account that allows you to contribute pre-tax dollars. This means that the money you contribute to the account is deducted from your taxable income. For example, if you make $50,000 a year and contribute $6,000 to your traditional IRA, your taxable income will be reduced to $44,000. This can save you hundreds of dollars on your tax bill. There are income limits for contributing to a traditional IRA. In 2021, if you're single and your modified adjusted gross income, MAGI, is $66,000 or less, you can contribute up to $6,000 to a traditional IRA. If you're married filing jointly, you can contribute up to $6,000 if your MAGI is $105,000 or less. 401k. A 401k is a retirement account offered by your employer. You can contribute pre-tax dollars to the account, which reduces your taxable income. In 2021, you can contribute up to $19,500 to your 401k. If you're 50 or older, you can contribute an additional $6,500. Roth IRA. A Roth IRA is a retirement account that allows you to contribute after-tax dollars. This means that you won't get a tax deduction for your contributions, but the money in the account grows tax-free, and you won't pay taxes on qualified withdrawals in retirement. There are income limits for contributing to a Roth IRA. In 2021, if you're single and your MAGI is $140,000 or less, you can contribute up to $6,000 to a Roth IRA. If you're married filing jointly, you can contribute up to $6,000 if your MAGI is $208,000 or less. Tip 2. Take advantage of tax credits. Tax credits are a great way to reduce your tax bill as they directly reduce the amount of taxes you owe. There are several tax credits available, including the Earned Income Tax Credit, EITC, the Child Tax Credit, the American Opportunity Tax Credit, and the Lifetime Learning Credit. Earned Income Tax Credit, EITC. The EITC is a credit for low to moderate income earners. The amount of the credit depends on your income and family size. In 2021, the maximum credit is $6,660 for families with 3 or more children. The credit is refundable, which means that if the credit is more than the taxes you owe, you'll receive a refund for the difference. To be eligible for the EITC, you must meet certain requirements, such as having earned income and filing a tax return. The income limits for the EITC are adjusted annually. In 2021, if you're single and have no children, your income must be less than $15,980 to qualify for the credit. If you have 3 or more children, your income must be less than $57,414. Child Tax Credit. The Child Tax Credit is a credit for families with dependent children. The credit is worth up to $2,000 per child and is partially refundable. To be eligible for the credit, your child must be under age 17 at the end of the tax year, and you must meet certain income requirements. In 2021, the income limit for the Child Tax Credit is $75,000 for single filers and $150,000 for married filing jointly. The credit is reduced by $50 for every $1,000 of income above these limits. American Opportunity Tax Credit. The American Opportunity Tax Credit is a credit for college expenses. The credit is worth up to $2,500 per year for each eligible student and is available for the first 4 years of college. To be eligible for the credit, you must be enrolled at least half-time in a degree or certificate program. The credit is partially refundable, which means that if the credit is more than the taxes you owe, you'll receive a refund for the difference. In 2021, the income limits for the American Opportunity Tax Credit are $80,000 for single filers and $160,000 for married filing jointly. Lifetime Learning Credit. The Lifetime Learning Credit is a credit for post-secondary education expenses. The credit is worth up to $2,000 per tax return, and there is no limit to the number of years you can claim the credit. To be eligible for the credit, you must be enrolled in at least one course at an eligible educational institution. The Lifetime Learning Credit is non-refundable, which means it can only reduce the amount of tax you owe to zero, but it won't provide a refund over that amount. In 2021, the income limits for the Lifetime Learning Credit are $69,000 for single filers and $138,000 for married filing jointly. Tip 3. Account for charitable contributions. Charitable contributions can be tax deductible if they are made to qualified organizations. These include religious organizations, educational institutions, government agencies, and more. It's important to note that you need to itemize your deductions to be able to deduct charitable contributions. For cash donations, you can deduct up to 60% of your adjusted gross income, AGI. For non-cash donations, such as property or clothing, you can generally deduct the fair market value of the items. If your contributions are more than your limit, you can carry them forward for up to 5 years. Make sure to keep a record of your donations, as you'll need to provide proof if you're audited by the IRS. For donations over $250, you'll need a written acknowledgement from the charity. Tip 4. Deduct medical expenses. Medical expenses can be a significant burden for many families, but they can also serve as a significant tax deduction. You can deduct medical expenses that are more than 7.5% of your AGI. This includes payments for diagnoses, treatments, preventive care, and more. You can also deduct travel expenses related to medical care, such as mileage, parking, and tolls. If you're self-employed and pay for your own health insurance, you can deduct the full cost of your premiums. Again, to take advantage of these deductions, you'll need to itemize your deductions on your tax return. These are just a few of the tax-saving strategies you can use to reduce your tax bill. Remember that everyone's tax situation is unique. So what works for one person may not work for another. Therefore, it's always a good idea to consult with a tax professional to ensure you're taking full advantage of all the tax breaks available to you. Subscribe and keep watching our other related videos. And we will see you soon.